Welcome to The Explainer. Look, today we're going to completely change how you see the financial markets. Whether you're actively trading forex pairs like the Euro USD, navigating the wild crypto markets, or just trading traditional stocks, we are pulling back the curtain. We're going to reveal the hidden language behind those mesmerizing financial charts you probably stare at every single day. If you've ever felt like the market is speaking some kind of secret foreign language, well, get ready, because we are about to completely decode it. Let me ask you something honestly. Are you reading your charts completely wrong? I mean, think back to your own experiences. How many times have you excitedly clicked buy just because a massive green candle was rocketing upward, giving you this intense rush of FOMO, only for the market to immediately reverse the absolute second you entered the trade? So many traders find themselves just blindly reacting to shapes on a screen, buying when they see green, selling when they see red, without actually understanding the underlying mechanics at play. It's kind of like trying to read a complex novel by only looking at the pictures, right? Well, today, we're going to change that. Okay, so here's our roadmap for today's explainer. First up, we'll cover the anatomy of a candlestick. Second, buyers, sellers, and the psychology behind them. Third, essential candlestick patterns. Number 4, the retail trader trap. And finally, number 5, smart money and institutions. Let's dive right into Section 1, anatomy of a candlestick, or what I like to call the weapons of the market. You see, a chart isn't just some boring mathematical graph. It is a literal battlefield where buyers and sellers are clashing in real time. Every single candlestick has a story. The thick part is the body, and that shows the opening and closing prices. But what I really want you to focus on are the thin lines extending above and below it. These are called wicks, or shadows. Think of them as the battle scars of a trading session. Let's say you're looking at a 1-hour chart on a major forex pair, right? The price opens and suddenly sellers just take total control, driving the price down hard for the first 45 minutes. But then, in the final 15 minutes, deep-pocketed buyers absolutely flood the market, absorbing all that selling pressure and driving the price all the way back up to where it started. That massive rejection leaves behind a long lower wick. It represents the absolute price extreme, the lowest point reached before the market violently pulled back. So the absolutely crucial point here is knowing who ultimately won the session. If the close is higher than the open, you get a bullish candle, typically colored green or white. That means buyers decisively took control. If the close is lower than the open, you get a bearish candle, usually red or black, meaning sellers claimed victory. And listen, the size matters immensely here. A long, thick body indicates absolute, unquestionable conviction from the winning side. It tells you for sure that they have the momentum heading into the next session. Conversely, a tiny body shows hesitation, hinting that the victor barely squeaked by and might be totally exhausted. Moving right along to Section 2, buyers, sellers, and psychology. Let's meet the combatants. When you look at these combatants, you gotta remember that you aren't just looking at math. You are looking at raw human emotion, fear, greed, and that utter desperation to be on the winning side. This quote from Dr. Alexander Elder perfectly sums it up. He says, "The humble candle embodies a perpetual battle between buyers and sellers, bulls and bears, weak hands and strong ones. Every single candle is literally a real-time footprint of an emotional tug-of-war. The open and close prices are actually the most emotionally charged moments of that specific time frame. The open represents the initial panic and strategy of the session, while the close represents that desperate, frantic rush to cover positions or secure profits before the clock runs out." All right, Section 3, essential candlestick patterns. Let's talk about reading the formations. So now that we know what individual candles represent, let's look at the stories they tell when they actually line up, starting with a total classic, the doji. Imagine a massive, grueling tug-of-war ending in a perfectly even tie. That is exactly what a doji is. The opening and closing prices are virtually identical, leaving this tiny or non-existent body with wicks on both sides. It signals absolute, perfect market indecision. Let's frame this with a quick hypothetical. Imagine the euro has been relentlessly climbing against the US dollar for 4 straight hours, completely exhausting the buyers. Then, boom, this doji prints. It's basically the market whispering to you that the current dominant force is running out of steam. The buying momentum is flatlined, and a major reversal might be right around the corner. Now, these two reversal patterns brilliantly illustrate the pain of the opposing side. On the left, we've got the hammer. Look at that incredibly long lower wick at the bottom of a downtrend. I mean, think about the sellers who pushed the price down that far, feeling so confident they'd secured a breakdown, only to be instantly overwhelmed by buyers who aggressively stepped in, completely rejecting that price floor. Then, on the right, the tweezer's bottom. It's a very similar story, but told over 2 trading sessions, a back-to-back rejection of the exact same low. It's honestly like the sellers hitting a brick wall twice in a row. Both of these patterns basically scream that the bears are completely losing their grip on the market. And then, oh man, we have one of the most reliable signals out there, the engulfing pattern. This isn't just indecision or a gentle rejection. This is a total hostile takeover. It's a dramatic shift in market psychology, where a larger candlestick completely swallows or engulfs the body of the previous smaller candle. Why does this trap so many people? Well, because the initial small red candle tricks retail traders into thinking the downtrend is continuing safely. They confidently place their short trades, and then literally the very next session, a massive green candle forms, not just matching the sellers, but decisively wiping them out and transferring total control to the buyers. Which brings us to Section 4, the retail trader trap. Let's reveal the puppet masters. Look, if trading were just about memorizing the shapes we just covered, everyone would be rich. But they obviously aren't. Let's read this quote and let the reality of it really sink in. Banks and financial institutions know how we trade the market, they know how we think, and where we put our stop losses. Have you ever entered a carefully planned trade, placed a perfectly logical stop loss right below a strong support line, only to watch the price dip down, take you out of the trade by a single pip, and then immediately reverse and go exactly where you predicted? Yeah, we've all been there. You need to realize right now, that support line isn't a protective wall. It's a target. That wasn't bad luck. That was engineered. Here's the deal. Big players, banks, financial institutions, hedge funds, they move millions or even billions of dollars at a time. If a massive bank wants to buy 10,000 lots of a currency pair, they can't just click buy like we do. If they did, the sheer size of their order would instantly spike the price upward, resulting in terrible entry prices for themselves. This is a concept known as slippage. To avoid this, they require a massive pool of opposing sell orders to absorb their buy order. They need liquidity. And what is the absolute easiest, most predictable place to find a massive pool of sell orders? Yep, the clusters of retail stop losses sitting right below obvious support levels or above obvious resistance levels. They literally intentionally engineer a temporary price drop, driving the market straight into these zones. Once your stop loss is triggered, you're forced to sell. The institutions use your forced selling to quietly fill their own massive buy orders at a discount, right before they reverse the market in their intended direction. And that leads perfectly into our final layer, Section 5, smart money and institutions, operating behind the scenes. To stop being the victim of these traps, you absolutely have to understand the stark difference between the everyday trader and the big institutions. Let's walk through this contrast because it's huge. Retail traders are driven by fear, greed, and FOMO. They nervously execute trades by chasing emotional breakouts and entering after the impulsive, exciting move has already happened. Smart money, on the other hand, they are cold, calculating, and completely devoid of emotion. They are driven purely by liquidity and market structure. They do not chase breakouts. Instead, they engineer manipulation to quietly accumulate their positions. And they only execute their real entries after the retail traders have been violently swept out of the market. Now, what's really interesting about this slide is, well, look closely at the price breaking below that blue support line. To a novice retail trader, a candlestick closing below support looks like a perfectly confirmed downtrend. Driven by the fear of missing out, they emotionally short the market, just piling into sell orders. But the smart money simply push the price down just long enough to trigger existing sell stops and trap these new breakout traders. Imagine the sheer panic of those retail traders as the very next candle violently reverses upward. They're now trapped in losing positions, and as they are forced to exit by buying back their positions, their panic buying literally fuels the institutional move higher. It's wild. This highly specific predatory maneuver actually has a name. It is called a liquidity sweep. It happens when smart money forces the price to trigger retail stop losses in order to generate enough liquidity to fill their own massive institutional orders. Think of smart money kind of like a massive whale opening its mouth to intentionally swallow a concentrated school of fish. These are not market accidents or random spikes. They are highly calculated business operations. And honestly, once you learn to spot the visual footprint of a liquidity sweep on your charts, your entire perspective on how the financial market moves will shift forever. So how do you actually stop fighting the institutions and start trading alongside them? Let's walk through this actionable blueprint, basically as if we're setting up a live trade together. First, identify the liquidity zones. Scan your chart and mark the obvious clean highs and lows where you just know retail traders are hiding their stops. Second, exercise patience. Seriously, don't buy the initial breakout. Wait for the sweep. Watch the price pierce that level and look for a fast, aggressive reversal wick. Third, confirm the shift. Don't just guess. Wait for a strong candle to close in the opposite direction, breaking the previous market structure. That reveals the real institutional intent. And finally, when you manage your risk, place your own stop loss safely beyond the extreme point of the liquidity sweep, safely tucked away from that typical retail trap. Understanding basic candlestick anatomy is powerful for sure, but deeply understanding the cold, calculating institutional intent behind those wicks and bodies, that is what gives you a true, lasting edge in the market. I'm going to leave you with this final provocative thought to ponder the very next time you open your charts and prepare to execute a trade. Are you setting the trap, or are you the liquidity? Keep studying, stay disciplined, and thank you so much for joining me on this explainer.
वीडियोस बनाने हैं, फिल्मोरा है ना।